Monthly income sounds great. That is why JEPI gets so much attention. Investors see the high yield, the monthly distributions, and the idea of getting paid regularly from one ETF. And on the surface, it sounds simple. Buy JEPI, collect monthly income, repeat. But investing is rarely that easy. The real question is not just how much JEPI pays. The real question is where that income comes from, what risks are behind it, and what you may be giving up in exchange. Because the yield is not the whole story. The strategy behind the yield matters. So in this video, we are going to break down what JEPI actually is, how it generates monthly income, who it may fit, who should be careful, and whether it still makes sense in 2026.
JEPI is the JPMorgan Equity Premium Income ETF. Its goal is to provide current income, monthly distributions, and some potential for capital appreciation. But JEPI is not just a normal dividend ETF. It is an equity income strategy. That means it owns U.S. large-cap stocks, but it also uses an options-based strategy through equity-linked notes. The fund is designed to generate income while also trying to deliver lower volatility than the broad U.S. large-cap market. That is why many investors see JEPI as a monthly income ETF. But this structure is very different from simply buying a fund like SCHD, VOO, or VTI. JEPI has a net expense ratio of 0.35%. So it is not extremely expensive, but it is also more expensive than many plain index ETFs. And to understand whether that cost makes sense, we need to understand
JEPI generates income from more than one source. Part of the income can come from the stocks inside the portfolio, but a major part of the strategy comes from option premiums, usually through equity-linked notes. The simple version is this. JEPI owns a basket of stocks and uses an options income strategy to generate additional cash flow. In exchange, the fund gives up part of the upside potential that a normal stock ETF might capture in a strong bull market for a strong bull run. That is the trade-off. JEPI turns market volatility into income, but that trade-off has a price. So when investors see monthly distributions, they should not think of them like guaranteed bond payments. They should think of them as the result of an active equity income strategy. That strategy can be useful, but it behaves differently from a simple dividend ETF. And that difference is exactly why JEPI became so popular.
JEP became popular because it gives investors something many people want: monthly income, a high-income focus, simple ETF access, a goal of lower volatility, and exposure to large U.S. companies without having to pick individual stocks. For retirees, pre-retirees, and income-focused investors, that can be very attractive. The official fact sheet showed a 30-day SEC yield of 8.29% and a 12-month rolling dividend yield of 8.33% as of May 31, 2026. Those are big numbers compared with many traditional dividend ETFs. But this is where investors need to slow down. A high yield today does not mean the yield will stay the same forever. Monthly income can fluctuate. And the reason it fluctuates is connected to how the strategy works. So before comparing JEP with other funds, we need to make one thing clear. JEP is not SCHD. JEPI and SCHD are often compared because both attract income-focused investors, but they are not doing the same job. SCHD is focused on dividend quality. It uses a dividend screen. It looks for companies with dividend history and fundamental strength. JEPI is different. JEPI is focused on equity income through an active options-based strategy. SCHD is more about dividend quality and dividend growth. JEPI is more about generating income now. That does not make one automatically better than the other. It means they are different tools. Comparing them only by yield can be misleading. SCHD is dividend quality. JEPI is income engineering. And just like JEPI is not SCHD, it is also not a replacement for broad market ETFs like VOO or VTI.
VOO and VTI are broad market growth tools. VOO tracks the S&P 500. VTI gives exposure to the total U.S. stock market. Those ETFs are built around long-term market participation and total return. JEPI is different. JEPI focuses more on monthly income and a lower volatility objective. That means it may not capture the same upside as VOO or VTI during strong bull markets. And that is not an accident. That is part of the strategy. JEPI trades part of market growth potential for income. So if an investor wants maximum long-term growth, JEPI may not be the best core holding. But if an investor wants income and is willing to accept a lower upside profile, JEPI may become more interesting. The key is understanding the trade-off, and that trade-off is the heart of the ETF. To end the market hours.
The main trade-off with JEPI is income versus upside. Options income strategies can collect premiums. Those premiums can help support monthly distributions. They can also make the ride feel smoother in certain market environments. But there is a cost. When the market rises strongly, JEPI may not participate as much as a plain stock ETF. That means JEPI can feel smart in choppy markets and frustrating in roaring bull markets. If the market moves sideways and volatility is elevated, income strategies can look attractive. But if large cap stocks are ripping higher, especially in a tech-led rally, JEPI may lag. This is why investors should not ask only how much does JEPI pay. They should ask, what am I giving up to receive that income? And one thing investors are giving up is certainty, because the yield itself is not fixed.
JEPI's yield is not guaranteed. That is one of the most important points in the entire video. The fund pays monthly distributions, but monthly does not mean fixed. The income can change based on market volatility, option premiums, dividends from the stocks, portfolio construction, and overall market conditions. If option premiums fall, the income may fall. If market conditions change, distributions may change. If the portfolio changes, income can also change. So investors should be very careful about building a financial plan as if JEPI's current yield will never move. High yield does not mean fixed income, and monthly income does not mean guaranteed income. JEPI can be useful, but investors need realistic expectations. The next risk is even more important because it is less obvious. JEPI looks simple on the surface, but the engine underneath is more complex.
JEPI uses equity-linked notes as part of its strategy. For many investors, that is where the fund becomes harder to understand. Equity-linked notes can help create the options income exposure that supports the fund's distributions, but they also add complexity. There can be liquidity risk, counterparty risk, valuation complexity, and potential losses if markets move in unexpected ways. This does not mean JEPI is bad. It means investors should understand that simple income on the surface can hide complex mechanics underneath. Buying JEPI is easy. Understanding exactly how the income is generated takes more work. That is why investors should not treat JEPI like a normal dividend ETF or a bond substitute. And there is another issue that many income investors forget until tax time: taxes.
The yield you see is not always the yield you keep. That matters a lot with income ETFs. If JEPI is held in a taxable account, monthly distributions may create tax drag. Depending on the type of income, investors may owe taxes every year, even if they reinvest the distributions. That can reduce after-tax returns. This is why account type matters. Some investors may prefer holding income strategies inside tax-advantaged accounts, like an IRA or Roth IRA, depending on their personal situation. But this is not tax advice. The point is that income before taxes and income after taxes can be very different. So when investors look at JEPI, they should not only ask, what is the yield? They should ask, what do I keep after taxes? And does this ETF fit my account strategy? And this is the kind of practical ETF analysis we focus on here.
This is the kind of no-hype ETF breakdown we focus on at Boring Money Wins. Not chasing yield blindly, not pretending monthly income is guaranteed, and not ignoring options, ELNs, taxes, upside trade-offs, or portfolio fit. If this kind of investing breakdown is useful, hit the like button and subscribe to the channel. It helps the channel grow, and it tells YouTube to show more practical investing content to people who want clear analysis instead of noise. Now that we understand how JEPI works and where the risks are, let's make this practical. Who may actually like JEPI, and who should be careful before buying it?
JEPI may appeal to investors who want monthly income. It may also appeal to retirees or pre-retirees who care more about cash flow than maximum growth. Investors who understand options income may also find JEPI interesting. And investors who want potentially lower volatility than the broad large-cap market may see JEPI as a useful income sleeve. But the key phrase is income over maximum growth. JEPI may fit investors who prioritize cash flow and are willing to accept the trade-offs. It may not be ideal for someone who wants the highest possible long-term capital appreciation. It may not be ideal for someone who expects JEPI to beat the S&P 500 in every market. And it may not be ideal for someone who does not understand how the income is produced. So JEPI can fit the right investor, but it can also be the wrong tool for the wrong goal. VEXO may fit investors who prioritize cash flow and are willing to accept the trade-offs. It may not be ideal for someone who wants the highest possible long-term capital appreciation. It may not be ideal for someone who expects JEPI to beat the S&P 500 in every market. And it may not be ideal for someone who does not understand how the income is produced. So JEPI can fit the right investor, but it can also be the wrong tool for the wrong goal.
Some investors should be careful with JEPI. Young investors focused mainly on growth may want to think twice before making JEPI a large core position. Yield chasers should also be careful. A high distribution rate can look attractive, but it does not automatically mean the ETF is safer or better by its own name. Investors who expect JEPI to fully participate in strong bull markets may also be disappointed. And anyone who does not understand options income, equity-linked notes, or tax drag should slow down before buying. JEPI is simple to buy, but not simple to fully understand. That is the key. The ETF can be useful, but it should not be bought just because the yield looks big on a screen behind its name. It needs a clear job in the portfolio. So let's talk about that job.
JEPI should have a job in the portfolio. It should not just be a big yield on the screen. One way to think about JEPI is as an income sleeve. That means it is one part of the portfolio designed to generate cash flow. Another investor might combine JEPI with a broad market core, like VOO or VTI, so the portfolio still has more growth exposure. Another investor might combine JEPI with bonds for income and stability. Some investors may compare JEPI with SCHD, but those two funds do different things. SCHD focuses more on dividend quality. JEPI focuses more on options-based income. The right allocation depends on age, goals, tax situation, risk tolerance, and income needs. So the question is not only, should I buy JEPI? The better question is, what problem is JEPI solving in my portfolio? And with that, we can bring everything together.
So can JEPI help investors generate monthly income in 2026? Yes, it can. JEPI can be a useful income tool for investors who understand the strategy. It offers monthly distributions, it uses an options income approach, and it may appeal to investors who care more about cash flow than maximum upside. But JEPI is not a magic income machine. The yield can change. Upside can be limited. ELNs add complexity. Taxes can matter. And JEPI does not automatically replace VOO, VTI, SCHD, or bonds. The balanced answer is this. JEPI may be useful as part of an income strategy, but only if the investor understands the trade-off. The best income strategy is not always the highest yield. It is the one you can actually understand and hold. That is the boring answer. And boring money usually wins, because boring money usually survives. Whew.